Hello and welcome to CNBC TV18's Mumbai studio. I'm Nikki Mirchandani and with me is my colleague Sonal Butra, and you're watching the Mutual Fund Corner. Indian equity markets have had an impressive run in 2024 due to various reasons, right? Including expectation of US Fed rate cut, ample liquidity, strong global market sentiment, and of course, let's talk about Q4 FY24 results too, amongst others. However, geopolitical concerns have casted a shadow of worry on Indian equity market. This is not the first time geopolitical turmoil has been a catalyst for turbulence for investors. Experts argue across that staying invested in a diversified, goal-aligned portfolio has only benefited through countless geopolitical crises, wars, pandemics, and recession. But how does one really navigate through the highs amidst volatility remains an important question.
Oh, it does. Absolutely, Nikki. So, we'll do one thing. We'll discuss this with our guests today. We are joined by Kalpen Parekh, the MD and CEO of DSP Mutual Fund, as well as Tarun, the founder and CEO of TBNG Capital Advisors. Gentlemen, thank you so much for joining us today. And today has definitely been the day of a lot of volatility. So, with so much volatility, Kalpen, let me start with you. We are talking about volatility in equity markets in the last couple of trading days, but gold scaling newer peaks. What kind of fund category or asset allocation would you say should an investor go ahead and would be the best choice for investors, especially for those who have missed out on catching the momentum in some of the asset classes?
Equity, the nature of equity is volatility, and what we've seen is barely anything. I think if we are debating volatility with a 4-5% price movement after being at all-time highs, and after markets have run up by 250 to 300% post-COVID in many pockets, this is barely any volatility. So I think investors should be conscious of that. That real volatility is when you see 20 to 30% drawdowns, and we've seen that in prior cycles. And in the last 3-4 years, post-COVID, we have barely seen that type of sharp fluctuation. Gold has a very important role to play, and the role of gold is always, noticed after it starts doing very well. So let me give you a long-term data point. Over the last 25 years, the median return of gold has been around close to 11.5 to 12%, roughly around 11% CAGR. And I'm using median, not from a low cycle to a high cycle. And the median return of equities, which is Nifty, has been 12%. So 11 and 12. If you just blend the two together, mathematically the average should be 11.5. But actually, if you were to have a portfolio which is 50 gold and 50 Nifty, and rebalance it every year or two whenever one asset class goes up, trim it and bring it back to 50-50, that portfolio would have earned 13% return, which is higher than the constituents at almost 35-40% lower volatility. So that is the advantage of gold as a volatility dampener. Typically, when stocks don't do well, and generally when do stocks not do well, it is characterized by either FII outflows, it is characterized by a falling currency. So those are the moments when actually gold happens to do well. So the correlation between gold and Nifty is very weak, or in fact even opposite at times. And that is why gold becomes a very important asset class. The best way to invest in gold is either through sovereign gold bonds or gold ETFs or multi-asset allocation funds, which can invest in gold and also rebalance them. So let's say our multi-asset allocation fund has 20% in gold and silver since the last 9 months or so, last 7 months or so. And if at all gold were to run up much sharply in coming quarters or year, we have the ability to rebalance a little bit and bring it back to equity. So for a common investor,
keep the question as is.
The most sense.
All right, Kalpen, sorry for the interruption there. Afternoon, how are you doing? You made substantial arguments relating to comparing the two asset class here. But gold as an asset class is seen more as a diversification tool, right? You think now it can be looked at any differently given the wealth creation opportunity it has to offer over the last 25 years or so? The returns that we've seen for Nifty versus that of gold almost seem to be similar. What's your assessment on it?
Yeah. I think gold, that's why I would say that gold plays an important role. I personally have between 12 to 15% of my portfolio in gold. But there is always merit in timing it, because remember, for 10 years, gold goes nowhere. And it's not easy to be patient in those periods when stocks are rising sharply and gold is going nowhere. So that's my first comment. And second, generally, I think Indians do have enough of gold in their portfolios because, as a nation of savers, gold and bonds and real estate has been our primary saving asset class. Equities only in the last few years people have embraced. So in that context, I would say it's a function of each individual's exposure to gold. If you do not have exposure to gold, I think it merits more so in this world where so much of printing of currency has happened in the last 15 years after 2008. I think gold is a valuable asset class as a volatility dampener.
And Indians love gold, right? Mostly in physical form, but of course, as you pointed out, sovereign gold bonds, be it gold ETFs, that's something everyone started looking at as well. Tarun, let me come to you, and the same questions for you. Considering the volatility that we are seeing, what is a good time to start for someone who has missed the rally, maybe in equity markets and gold as well?
Yeah, so I feel the FOMO factor in the market is very high. And this is the time we should actually talk about avoiding FOMO, right? I think we're in everyday fear of missing out, where most of the asset classes have done so well in last 6 months to 1 year. Every asset class has performed very well, be it equity, debt, gold. So I think, first of all, one need to look at its individual suitability. What are they actually looking at? That is most important thing. I wish everybody start getting more rational while investing, which never happens, but that is one thing to look at. The environment we are in right now definitely warrants asset class like gold because of the war, and I think the situation in US, which I think recently what we have observed, wherein the US treasuries are also hardening in short term, and I think the crude prices have also gone up. All these are making us point that I think gold should do well in this environment. But I feel gold is a true diversification from equity. If it is part of a portfolio, it will give you a meaningful diversification. And I think long-term data is again telling us the same thing, but gold is a inflation-linked asset. So I don't think you can compare gold with equities. So equity continues to be a wealth creation asset, and investors should look at equity from that point of view, and gold should be more as a part of diversification portfolio. And I feel in the current environment, most of the multi-asset portfolio, which I think Kalpen just mentioned, those are apt to capture the gold because timing is very critical in gold, and that is my experience also has been same in this asset class. So maybe a multi-asset portfolio, a fund manager can use various data points to take action of increasing and reducing gold, which I think as an individual investor, nobody has the know-how to take those actions. So a multi-asset or asset allocation funds are the best bet according to me. One can look at if they want to capture the gold rally.
Okay, so multi-asset allocation funds, that's the best way to catch the gold rallies. That's been a unanimous opinion actually. But Tarun, let me come to you. You know, this is something that we get from retail investors most of the times. They give you an amount and they ask you where to invest. So say if an investor has 10 lakh rupees to invest right now, where should they invest considering the risk profiles? Of course, that would differ for everyone.
Right. So I think if any investor who is looking at fresh investment, the most important part is if he is a first time investor, I would always recommend start with little bit more on the hybrid side, because I think investing experience is the most important part to start with. I think for first 6 months, 1 year, 2 years, if investor will see lesser volatility, I think it will help him to become a better investor over a long period of time. So if starting first time, maybe a hybrid kind of allocation would be a best bet. Otherwise, if the investor is a seasoned portfolio investor and invested in the past, maybe diversified equity and more bias towards large cap would be something I would recommend. Flexi cap category also is a good category to explore, but I feel generally the index fund again is as a category. Passive funds is something one can explore because 80 to 90% of the active funds on the large cap side is not able to perform that well. So maybe a passive fund again can give a very good experience to start with. But again, investor need to take care of the suitability part. Long-term experience will only get better if the suitability is taken care of.
All right, Kalpen, I'm going to come to you on this one. Monthly AMFI data is suggested in small cap funds has, of course, witnessed an outflow for the first time in over 2 years in the month of March, after the capital market regulator highlighted its concerns over the froth in the smaller cap segments. Kalpen, you believe now large caps would be the preferred theme going forward. What's your strategy? as the fund house. Historically, 81% of small cap funds have underperformed their benchmarks in 2024 thus far.
So see the irony, just a minute back, Tarun mentioned that 80% of large cap active funds don't beat large cap benchmarks. And this was the narrative till 2 years back. So all the questions to us used to be, is it better to be in index? And in the last 18 months, the small cap indices are doing better than small cap funds. And on the contrary, large cap active funds are delivering better than large cap index. So in the last 18 months or so, 60-70% of large cap funds have delivered better than benchmark. But coming back to your question, see this month again, flows is a very noisy data point, and honestly, I don't read too much into it at this point in time. In the month of April, in the last 2 weeks, again, small cap flows have been positive. The month of March, they were negative because there was a bit of nervousness with all the headlines and regulatory action around small caps. No doubt, small caps are expensive. In fact, mid caps are more expensive than small caps as well. So that bucket, because there are few good stocks and there's a lot more money chasing them, valuations have gone up. We published our Netra a few days back where we highlighted that valuation of the mid and small cap bucket is far higher than what it had been in the last few cycles in 2007-8 as well as 2017. So from these levels, at least in my portfolio, I will have more bias towards large cap. At DSP, again, we do more of stock picking. So there are pockets of small caps where companies are high quality and stocks are cheaper. They have not participated in the last 2-3 years. Those type of companies we have in our portfolio. So again, I'm not generalizing. At large, small caps are expensive, mid caps are expensive. So you should tilt your portfolios more towards flexi cap and large cap. In my flexi cap, because the fund manager will navigate you, he will tilt the exposure from small to mid or mid to large, depending on how market cycles play out, and also to get the advantage of choosing quality small and mid caps, which may not have participated in the last 2 years or so.
Point well taken there. We're of course going to be talking about the small cap funds in a bit more details, but Tarun, I'm going to come to you and ask, is your narrative any different than what Kalpen has to sound off, or you think large cap is the preferred theme going forward to you as well? It's something that we've been listening right from the start of the year. Does that narrative change anytime soon?
These small cap and mid cap, I think from time to time one need to keep looking at valuation, and as rightly mentioned by Kalpen, I think the valuations are at all-time high. The valuations are approximately 35 PE is the average PE levels of the small and mid caps what we are observing right now compared to 21-22 times. So it seems to be on a higher level from a valuation front, and I think the environment which is building up right now, again, I feel it is good to where last 3-year experience of investors have been very good. The returns have been high double-digit returns investors have already achieved. So it would be good to take back some profits and rebalance the portfolio more into, let's say, debt or large cap category. And again, that small portion of the money which you rebalance, I think will bring more durability, long-term durability to the portfolio. Again, nobody knows what is going to happen in 6 months, 1 year, because I think like we are observing most of the asset classes are behaving very differently right now. But I think what would be good for investor is when valuations are giving you indicators, from a fundamental point of view, I think it makes sense to do some bit of rebalancing into this portfolio.
Okay, we take that point. Gentlemen, it's a very interesting chat, but we have to get into a quick commercial break. When we come back, we'll continue our discussion with what to do with your portfolio in volatile times like these.
Welcome back to Mutual Fund Corner. Still have with us Kalpen Parekh and Tarun, of course, with us. The second round of stress test results for mutual fund has been released. This test was initiated following a recent directive from SEBI, the capital market regulator, back in Feb. The results closely mirrored those from the first round of tests conducted in mid-March. What really stood out for you in mutual fund stress tests, part 2 results, or the one that we've seen in the previous month, is it as bad as it sounds? Kalpen, this one is for you.
I think it was not as bad even last month. So if, I only want to just advise investors not to panic. SEBI has been taking various measures over the last decade to only make mutual funds safer. And make investors aware not to get greedy towards extreme points in the cycle. I think the bigger risk is in buying directly small cap stocks. In the last 1 year, companies with less than single digit ROEs have delivered 200 to 300% returns. And companies with 18 to 20% ROEs have actually underperformed the market. So the real risk is actually somewhere else, number one. Number two, I think mutual funds have adequately managed and navigated various crises in the last 15 years, right from the 2007-8 GFC crisis to the 2017-18 small and mid cap sharp correction to COVID, to the credit crisis and all of that. Fund managers are competent. Your fund managers are competent to navigate through liquidity whenever there is an issue like that. Of course, that does not take away the fact that the nature of the beast, the nature of small caps. So when there are brutal corrections in the market, and they happen once every 7-8 years, if large caps have fallen by 40 to 45%, the mid and small cap buckets have fallen by 50 to 60%. No testing of stress or liquidity testing will take away those type of corrections. So that is the nature of the beast. And I think mutual funds, if you see the data which has been released even for the last month, you are seeing only marginal improvement in terms of ability to liquidate large parts of the portfolio in a matter of a few weeks. So I don't think it's a matter of worry. Most importantly, in small caps, the industry has been very responsible for the last 4 or 5 years to encourage a lot of SIPs over time, not just today. So that is why even the liability side of most funds, including ours, is very broad-based. So, not almost 95% of our investors have invested through small ticket sizes or through SIPs. We do not really have lumpy money in the category. Across industries, I can probably make that comment. So keeping those nuances in mind, investors should not worry. If they have space for adding small caps to their portfolio over a long period of time, small caps have delivered 2 to 4% more than the large cap universe. So just be conscious of that and don't react to headlines in panic.
Kalpen, that was my actually a follow-up to that, because DSP small cap fund, which reported in a 32 days to liquidate half of its portfolio. Also, the numbers have been, the days have been same for the stress test 1 and 2. So nothing really has improved dramatically. What could you help us understand the rationale behind it? How can one read into it? From what I could gather from this test test, I could see the larger the fund size, the longer it would take to liquidate. Have I got that correct?
Partly that, partly larger the fund size, it does take longer because number one. Number two, we have always maintained this position, and more so even now, after all this debate, that our small cap fund is a dedicated pure small cap fund. We do not take large caps in our small cap fund, even though SEBI rules allow up to 20% into a non-small cap category, which means we can have large caps or mid caps in that bucket. But our promise to our investors is that this is a pure small cap fund. And if you want large caps, you can buy our large cap fund, or you can buy anyone else's large cap fund or a flexi cap fund. But this fund will be a 100% small cap portfolio. So to that extent, our numbers or the optics may look a bit different than optics of some other funds which have 20% in large caps. But we don't want to respond to optics or react to optics because we are comfortable with the quality of our portfolio, individual liquidity of our portfolio. And we are very comfortable also because in the last 5 years, 85% of our inflows have come only through SIPs and retail investors. So we don't think, that might see any significant outflow at the same point in time because we don't have lumpy investors. And hence, we decided very clearly, even after, the stress test, requirement by SEBI, that we will maintain its character as a pure small cap fund. We will not dilute it by adding large caps to it.
Okay, we've discussed small caps in details and the stress test as well. So I think it's time to move on because we are talking about the other categories of the market as well. Tarun, let me come to you. There are different risk appetites. We're talking about a volatile time. What would your advice be in terms of asset allocation, considering the risk appetite?
So I think risk appetite, according to me, the hero of the movie is asset allocation, right? So here Amitabh Bachchan is only asset allocation, and long-term returns are only created because of the smart asset allocation one brings to the portfolio. So I don't think from time to time markets will keep changing asset allocation. I think asset allocation is more to do with the risk tolerance level of the investor. I think risk capacity is very different and risk tolerance is very different. So once risk tolerance is very clear, I think investor, if he has an aggressive risk appetite, definitely asset classes like equity, real estate should be part of the larger portfolio. But if the risk appetite is less, we need to look at other asset classes. The environment we are in, yes, I think some bit of tactical portfolio can be built based on the environment you are in right now. So if you ask me today if I will build the portfolio, if I would have invested 1 year back in a small cap allocation, I would have done in 5 months staggered investment, but today I will do it in 10 months staggered investment because I feel the valuations are much higher, right? So I think from time to time, the tactical part of the portfolio, I will keep changing deployment strategy based on that. Due to that right now. But I think I can see a lot of interesting additions like InvITs in the portfolio, REITs and InvITs in the portfolio, which is again very interesting to see good yields coming back in this category, and with the real estate, commercial real estate also going up. That is also one category investors can look at.
Okay, all right. Tarun, we get that point. But tell us, what trends are you picking up when it comes to international markets? Is there any way an exposure can be taken there?
So international market, I think I like this, all these AI oriented funds or robotic funds. And I genuinely feel it is a long-term trend. Which I think it's a structural change which is happening in the way we look at work, we look at things. So allocation, something on robotics or AI kind of category would be an interesting addition. There are some funds which are mimicking that, but I think there has been some SEBI directive again on the flows of the international fund. I think there are less options available to invest outside India. But I think once this window again opens up, that is one category I would be interested to add more allocation. I think ESG and all those categories are also good, but I think I don't read too much into that. I think from a trend perspective, technology enhancement is one area I would definitely look at.
All right, and that's something that has been a growing theme. Gentlemen, it was a pleasure speaking with both of you today to understand what to do when markets are volatile. So the advice is stay put, and you both have spoken about multi-cap or flexi-cap funds to look at, or multi-asset allocation funds to look at in times like these. With that, we'll take your leave on this edition of MF Corner today, but you stay tuned for Closing Bell to take you through the last hour of trade.